Well, here we go. Welcome back, everyone, to another Stock Market Open live stream. Today, we have the critical CPI report to cover. It's a big deal. There is no understating this report. This feels like it's not just any CPI report, but frankly, it feels like it's a CPI report on steroids. It feels like it is either the report that is going to reiterate Jerome Powell's dovishness and Jerome Powell's interest in being, a little sort of casual about inflation after the January, February numbers. Or it's going to slap Jerome Powell in the face, and it's going to say, J. Powell, you're wrong. Now, of course, if Jerome Powell gets access to all that delicious insider info or early releasing of information, then who knows? Maybe he already knows the answer. Maybe Bostic already knew the answer yesterday, and he knew that the numbers were going to come in at expectation today. That's what we kind of got hinted at yesterday by Raphael Bostic. Remember that Bostic yesterday has previously been the person who said, we might do no rate cuts in the long term. We might end up doing one cut. We might do a cut and then a pause. We might do rate hikes. He's sort of been the loose cannon, if you will. It's almost like they use him as a weapon to see how the market's going to react to the loony things or loony potential options that maybe they're thinking of. But the reality is, right now, we have the real data coming. So rather than, to the extent that it's more than just speculation of listening to what Bostic says, it's probably still, as we like to say, the CP lie, but at least it's a little bit more concrete than the speculation of, did Bostic get a leak or not? So we'll see. Anyway, it's going to be a big deal, and the data comes out in 3 minutes from now. So, big deal. We'll be covering this. Now, things to watch. Obviously, as the data comes out, what you're going to be listening for is you want CPI. Really, the most important one is the CPI core, and then of course we'll get into calculating supercore. Calculating CPI supercore takes a little longer, and so it'll probably take about 5 minutes or so before the street really starts getting the supercore number out. But really, what you're going to be looking for is that core number. Is it going to come in at 0.3? At this point, based on what Bostic told us yesterday, 0.3 would be good news. So at expectation deemed to be good news. If we end up getting 0.2, we're going to the moon. You're looking at your triple Qs and you're wanting to go in hard, maybe, not financial advice. Then you've got, if we get a 0.4 or above, you're probably going SQQ. Let's see. Let's go ahead and get this all prepped out. We're going to go write it down on ehack.com quickly as well, just so we can throw the numbers up there. Although the biggest priority won't be writing it over there, it'll just be getting through the actual data. Expected, and again, so CPI month over month, 0.3, CPI month over month core, 0.3, these are the expectations, CPI year over year, 3.4 expected, and 3.7 on year-over-year core. Actual result. Okay, cool. And there we go. That template is set, so we are ready. So the next thing, too, is we'll actually go through obviously the BLS report. We'll go through all the details. We'll see what the suits are saying. Something to remember as well is you've got... well, I think most of you already know this. Anytime I send trade alerts, buy, sell trade alerts, that's in the Stocks and Psychology of Money group. Feel free to join us. Yesterday we had a good day. It was another $1,800 on one move and $4,500 on another, and we'll see what we're gonna do here. We've been getting pretty some pretty fun trades in, so it's been fun. But now we've got 30 seconds to go. 30 seconds to go, and going into this, let's do a quick threshold check. We've got 16 basis points on the Qs. Gold is at 23.67. Bonds are down again. We went from 4.44 down to 4.34. 5 basically here. So we kind of keep going down here. It makes you kind of wonder if there's a leaky doodle. Here we go. CPI core is... come on. It's coming in. Year over year, 0.4. Bad news. CPI month over month comes in at 0.4. CPI month over month core comes in at 0.4. Bostic didn't know. That's bad. CPI year over year comes in at 3.5. Everything comes in 0.1 high. Every single number comes in 0.1 hot. The CPI report comes in hot. Not great. Let's go ahead and get the suit reactions here. We are still waiting for the BLS to actually show their numbers here. Numbers not actually out, but on the actual BLS report yet. But I am looking for the report to show up. And then let me look here if we have any revisions yet. We have real average hourly earnings coming in at 0.6. Weekly earnings coming in at 0.6. Again, CPI month over month coming in at a 0.4. We have core coming in at 0.4. We have year over year coming in at 3.5. And we have that year over year core coming in at 3.8. Every single number comes in 0.1 hot. That is unfortunate. That is not what markets were hoping for. Markets were really looking for a reason to be bullish here. And there we go. Okay, the PDF is now out. Markets were really looking for a reason to be bullish here. We had bullishness going into the end of the day yesterday. You could see the Qs literally just went from up 16 basis points to down 1.11% here. So you're looking at a very, very large move down. I'm going to actually go straight to the tables to see what the hell happened here because it's bad. So we're going to go right to the detailed expense table, and we can look at the summary in a moment. I'm also watching the suits as they go through it. So far, everybody's just saying, yeah, everything's up 0.1 compared to expectations. And then let's go ahead and jump into here. All right, so you know how I like to do this, folks. Okay, we're going to go all the way to the bottom. You go to page 16 all the way at the bottom. Legal services, and then keep in mind how the columns work. On the right side, seasonally adjusted. That's the number we use. The far right is February to March. All right, February to March. What did we get? We got funeral expenses. Come on, funeral folks. 1.5%. That's way too hot. Apparel services other than laundry, 2.2. Way too hot. Checking account and other bank services, 1.4. That's still way too hot. These numbers are way too high. Miscellaneous personal services coming here at 1.3. That's bad. Honestly, this should just be red. There we go. So miscellaneous personal services coming in too hot. Other personal services. I warned yesterday we need personal services to come in soft. And instead, we're at 0.8 here. Not great. So postage and delivery comes in at 0.4. That's been hot for a while now, the last 3 months. We did get a minus 0.2 on telephone services, but come on, who still signs up for that crap? Education and communication comes in at only 0.2. That's actually a good thing. I like to see that. Then we've got recreation services coming in at negative 0.8. That's good. There we go. Once again, it's the pet services. I warned about this yesterday as well. I said personal care services, financial services, insurances, and pet services. Those are the hot ones to look for. Pet services skyrocket, 1.9%. Folks, that's on a month-over-month basis, so you have to remember how bad that is. When you go 1.9%, you multiply it by 12, you're looking at 22.8% on an annualized basis. It's freaking nuts. Where's the transitoriness? It's not ideal. Recreation services, though, overall coming in at just 0.1. That's actually very good. We like to see that. So very good here. But don't go buy any video discs or other media because those came in at 14.7. Holy smokes. Okay, looking here, we've got motor vehicle insurance. There it is, folks. There it is. Look at that. Look at that lagging insurance aspect. Insurance lags. It is one of the last things that goes up because you got to get your costs up first, and then insurance companies are like, oh no, we need to raise our prices, and then all of a sudden they update your contracts. It's bad. So 2.6%, not good. Look at that motor vehicle repair, also not good. This is pretty broad-based so far. I'm not liking this. This is not just one section. I'm seeing a lot of sections. Oh, look at this. Motor vehicle maintenance and repair, 1.7%. Nuts. Car and truck rental actually comes in negative. That's good. Very good. Car and truck rental coming in negative here. But because of the motor vehicle insurance and those motor vehicle repair prices, look at that, 1.5% on transportation services. There it is. What I tell you, health insurance costs 1.2%. Big problem. Care of elderly or invalids at elderly homes, 5.9%. Holy smokes. This all adds up to hospital services coming in 1% hot. Hospital and related, 1.2, not good. Medical care services, 0.6, way too hot. That's 7.2% annualized. Way too hot. This is way too broad-based and way too hot. 0.7 on moving and storage. Household operations, 0.8. Oh, okay. This reiterates, by the way, January and February being bad. This is not good. Shelter, you've got 0.4 on shelter. You've got, and remember, the next real catalyst, I mean, you've got PPI tomorrow, but who cares? Like, your next big catalyst is really JPOW addressing this crap on May 1st. So you could have 3 weeks of just like, oh, here's your little 3-week correction. I don't know. We'll speculate in a moment. But shelter services, less energy services, 0.5. Shelter comes in at 0.4, same as last month. Rent of shelter goes up. We've got owner's equivalent rent still sitting at 0.4. Really need that number to go up. Tenant and household insurance, once again, hot, 0.5. No. Here we get to goods. Personal care products, 0.2, not a surprise. Other goods, 0.2, not a surprise. Alcoholic beverages away from home, 0.4, fine. Alcohol in general, 0.1. Education commodities, negative 1.2. Toys, negative 1.7. Sporting goods, negative 1. Pet and pet foods, 0.4. Recreation commodities, negative 0.5. Medical care commodities, 0.2. As you can see here, you're negative almost across the board. New cars, new trucks, used trucks, negative 1.1%. So not an issue here on goods at all. You do have girls' apparel coming in at 5.9%. I don't know what it is with girls' apparel here, but that's ridiculously high. Women's outerwear specifically. But anyway, okay, goods, nobody really cares about this. Here's some of the items pushing up core inflation on a monthly basis. Yep, on top of housing costs. Car insurance, clothing, personal care, education, household furnishings, medical care. In other words, the list is quite long. Equity futures continue their decline. 10-year yields just rose to about 4.45. That's our high of last year. Last week. You've got a Tesla now down 2.5%. The Qs are now down 1.5%. The SPY is now down 1.3. Sunrun, interest rate sensitive. I warned you yesterday. I said the interest rate sensitives get reamed if we get a 0.4. There you go. 6.3 down on Sunrun. Tesla down 2.5%. That's actually not that bad for Tesla. You've got Enphase down 5%. Google's down about 90 basis points. Bitcoin drops about $1,000. Nvidia, another 1% down. ARM goes down 3%. Big volatile move there. Super microcomputer, 4%, though it does look like we're trying to potentially bottom on this one. These are the average candles. We'll see if we do end up getting a bottom here. Looks like the Qs are trying to bounce right here at about the 435 line. Do have a support right there at that 435. We can see we broke through the previous one there. So now we've got global chief strategist at JPM Asset Management tells Bloomberg TV that the door just slammed for a June rate cut. Yeah. Okay, we've got Nick T, who tells us core CPI printed above forecast expectations for the third straight month. Yeah, no kidding. That's not good. Core CPI prints, oh wow, the actual exact number is 0.36. So that's how you got your round up to 0.4. Worth noting that wasn't 0.4 broadly, it was a round up from 3.6 for whatever that's worth. 12-month core inflation rate rose from 3.75 to 3.8 in March. 6-month was the highest since July 2023. So once again, not great because you are seeing the trend up. This is mostly problematic because you have this issue where Jerome Powell's going to have to somehow prevent this. And so you're going to get some people who are going to say, look, we might need rate hikes again. And you could look on screen right here and you see this resurgence. Unfortunately, at this point, I mean, we did get down there on the 3-month all the way down to like 2.3, but unfortunately, the last 3 months, it's been straight up. We've had this second wave or this resurgence of inflation, so not great at all, and obviously that's what's leading to the sell down here. Now, quick check again. Let's take a look here. We've got oil up at 90 on Brent. That's been pretty stable. You've got, wow, okay, the 10-year actually jumps not to 4.44 of the high of last week, but actually jumps to 4.5. That's even hotter. Now you've got gold's actually down 15 basis points on this. So gold's clearly not really being used as an inflation hedge here. It's apparently, which is weird, but it's apparently being more probably bought by speculators in China that the Chinese economy is stimulating and growing again, and potentially that is driving gold ETF demand in China. Okay, let's look at the heading here. Okay, so this is the actual initial release. We usually do this portion first, but we went for the details first instead this time, which I don't think is really that big of a deal. I actually find the details much more important. I like to always say the devil is in the details. But what you're going to find here is we have CPI-U increase 0.4. We've got same increase as February. Over the last 12 months, all items index increased 3.5 before the seasonal adjustment. Index for shelter rose in March, as did the index for gasoline. Combined, gas and shelter contributed to over half of the monthly increase. Now, what's interesting is lately, housing has actually been contributing somewhere around, I feel like 70% when we get these reports. And so the fact that now they're saying gas and housing is contributing to 50%, you're actually seeing housing contribute less. So I'm going to write that here. Housing seems to be contributing less, since it did used to attribute somewhere around 60 to 70% to housing. Let's see, yeah, and then we get into just really the charts, which we basically already went through the charts here, so, this is not going to be that big of a deal. It's just going to be redundant. Okay, good. So let me get some more reaction here. The Q's down another 9 basis points since our last check. Okay, now we're getting some street reaction. Head of U.S. rates and strategy at Amerivet Securities says the stronger than expected CPI confirms a more cautious approach towards rate cuts for the FOMC. It also supports our bearish view on the Treasury market in the short term. This is, at this point, honestly, this is also more than just bumpy. Remember, the Fed told us, hey, look, it's going to be bumpy on the way down. We're going to have challenges getting down to 2%. But now we're 3 months in a row of not so great data. And that's a little bit more scary. Chris noted the decline in used and car truck prices. That is true. Those are volatile, but those did come down. But again, car insurance did rise notably. Year-over-year inflation rose sharply in the mid-Atlantic to New England states. Interesting. Okay. So, East Coast really getting hammered there. All right, Supercore. Okay. Oh, dear. Oh, okay. Yeah, that's not great. So, Supercore comes in at 0.647. That's pretty dang hot, because if you annualize that, you're at like over 8% annualized on Supercore. Once again, not great. I will put up a screenshot here. Shout out to Zero Hedge for the chart. They always put this together. They do a great job with this. So here's your Supercore year-over-year number right here on the bottom. And so you could see Supercore conducting its second wave right here. This is not delicious. Not delicious right here. So you'll notice this sort of U-turn that you're getting right here. This is really second wavy right here. And then if you look at the composition on the month over month, it's trash. We don't even have a slight negative here. Last month we had a negative on personal care services and a little bit of personal care services. Both of those jumped to the hot side. Medical care services contributed, transportation services, personal care services. I mean, we went through this, folks. Supercore is basically trying to remove housing from services just to see, hey, what's going on here? And what you'll notice is Supercore has actually been rising since the middle of last year. We bottomed out at about June or July on CPI Super Core, and frankly, it's been straight up since then. We have not actually had a straight up like this since, quite frankly, mid-2021 to when the Federal Reserve started raising rates. So you can see that like 12-month straight up right here, which is starting to align with this like 12-month straight up over here on the right. So not super ideal, though it does look like some stocks are trying to find their bottoms for the morning. You've got the Qs are really trying to stabilize at that 435 number. Tesla's trying to recover right now. It looks like we're coming up, going back up to about in the 2% direction. Sunrun's trying to find its bottom down about 7%. Enphase is looking for it somewhere here in the 4.5% range. Amazon dumps 1.7%. On this. Nvidia down about 1.5%. Let's try to see some of the biggest movers here. You've got pretty much everything red. Look at that. We have very, very few items red. And the first one is the green. The first one is the VIX. So if we remove that, we've got Embraer, Cheesecake, Alibaba. These folks are green. Flip on to the other side, and as you would expect, the smaller caps, the riskier plays, your Carvana, Open Doors, and then, of course, your interest rate sensitives, the Sunrun, Enphase, consumer debt spending on a firm down 475, some of the more, again, interest rate sensitives. Okay, not a surprise. Now, let's get a little bit more here from the suits. This was a pivotal, oh my gosh, Kevin, wake up. This was a pivotal report for the market since the last two reports were a little high, and the Fed viewed those as a bump in the road rather than something sort of meaningful or a trend towards inflation resurging or something like that. Well, now this sort of flips that, unfortunately, and this is very clearly going to lead interest rates to move up in the near term with the Treasury market. We'll also want to see how the market is now pricing in expectations for 3 rate cuts this year. My guess is we're probably, after this report, going down to 2, and the earliest cut in September. That's my guess, and it wouldn't surprise me. We'll see if we can get a little bit. Let me see what they're saying here for a moment.
Is this something that is a knee-jerk reaction? Is this a complete overhaul of how you look at things? Because we're still talking about a pretty strong economy in a lot of other areas. Does inflation eclipse all of that?
Well, again, I think you have to certainly keep it in consideration. I mean, I think hearing all the perspectives just the past few minutes.
All right, this person's boring. So you're looking at about negative 2.3 is where we're sitting for rate cuts right now based on the market. 2.3 rate cuts as opposed to like 3.0, right? So 3.0 rate cuts would be a full 3 cuts. Right now, market is sitting at 2.3 cuts. And that 2.3 cuts actually comes in January, by January 29th. Oh, wow. Okay. We're actually under 2 rate cuts right now for December. So we're looking at 1.972 rate cuts for December. I can actually adjust that chart to yesterday. Oh, whoa. Yesterday, we were literally sitting at 2.65 rate cuts. And today, we moved to under 2 rate cuts. 1.93 is the present market reaction. So we've completely killed the 3rd rate cut, and we are sitting now fully on the under the 2 rate cuts figure. So let's see. Somebody here says, I wouldn't be surprised to see a wave of Fed forecast revisions after this. Yeah, well, we're not going to get another summary of economic projections until July. The Qs do seem like they're trying to move up, or at least find a floor. Keep in mind, when this market opens, what you're really going to want to pay attention to is, are fund managers deploying their cash and buying this dip? or are they selling this? That's going to be a big one in my opinion. Are institutions moving their money in? You can see what retail has done here. Retail has said, got it, hot number, I short. And you made money. I mean, if you moved on that first candlestick, you went much further down. And so now you've got some of the early morning buy the dip moving in. This is very, very common, very normal after these reports. The question is, what happens over the next few days? What is this going to mean for the PPI report tomorrow? Again, same time I'll be covering the PPI report, but all of the numbers coming in 0.1 hot on CPI is not great, and that's exactly why we've just lost our third rate cut. We've got, let's see here, JP Morgan strategist here has something to say. Most of the strength in core is explained by firmer motor vehicle insurance and medical care. Both of those feed into core PCE deflator in the same way, so the incoming Fed speak will be very important. Yep, we'll get Fed speak over the next few days. We'll actually get the minutes later today. So we'll get minutes later today. We'll get Fed speak over the next couple days, including today. We'll also get JPOW more realistically, though, on the, let's see here, Federal Reserve. We'll get JPOW on the 1st. You've got news and events, speeches. Today is, what's today? Let me see here, calendar. There we go. Okay, today is the 10th. So we'll get the minutes at 11 a.m. You have Bowman, who speaks at, where's this? Oh, she's speaking at some economic forum somewhere. I don't know if she's doing some Zoom call or whatever. I don't know if she's actually going to be in a place where she's reacting to the CPI yet, but I haven't seen any kind of Bowman headlines just yet. But it looks like her event is just now starting. So you could get a few Bowman headlines soon. Then I know we've got a lot more Fed speak coming in the next 2 days thereafter. So let's see what, in the meantime, the Doomers have here, and see if they've got any commentary for us right here.
Rate and what that neutral rate should be. The reality is the Fed Reserve was trying to stimulate the economy when there was a debt overhang. The debt overhang was weighing heavily on the economy, and the Federal Reserve was doing what it was supposed to do, offsetting that debt overhang with very, very low subsidy levels of interest rates. COVID cleaned out that debt overhang. Now there is no debt overhang. Balance sheets are exceptionally healthy. The economy has back its animal spirits, and therefore the Federal Reserve needs to be taming back on those animal spirits by...
Well, that's the fear. Is the Federal Reserve going to, try to punish markets for their enthusiasm? Let's see if the 5-year break-even moved up. It should have moved up on this. Yesterday, we were at about 2.5. We broke above that a slight little bit in the previous day. Oh, okay, yeah, 2.55. This is a spike up by about 5 basis points. On the 5-year break-even, we've seen moves like that pretty rapidly. It's actually not as high as I would have thought it would have moved, but it's certainly a chunk up. And then you are settling right now on that 10-year bond yield at about 4.48. And of course, every index is down over about 1.2%. At this point as well, bets for a June rate cut have all but evaporated. And the outlook for July is now looking even shakier. Remember, folks, one of the issues we had here is that the market basically broadly said, oh, yeah, everybody's expecting June for rate cuts. And one of the things that I warned is I said, hey, it's a problem when everybody has this much consensus for June, because if we don't meet that, we're going to have a little ouchy-wouchy. And so we're getting a little bit of that ouchy-wouchy right now. I have that on, let me throw this on screen right here. There we go. I have that on ehack.com, so if you want to see it, it's there. 042. Okay, so we're going to go right, take a look on screen right now. On the 2nd of April, I posted the following chart, and this is a really big deal. Nick T here wrote, make sure to get all of Meet Kevin's buy-sell alerts by being part of the Stocks and Psychology of Money group. The price goes up again within about the next 10 days. We've got some new lectures in progress as well, so new content for everybody. Make sure you join that. And if you want to bundle up with any of the courses, the event, or from an existing course, email us at staff@meetkevin.com, staff@meetkevin.com. Okay, so as you can see on the chart here, Nick T actually put together a summary of all of these different banks looking for June. Everybody here is at June for rate cut expectations. Mitsu's the only one who's at no cuts in 2024, and the Nomura's at July. They didn't put State Street in here. State Street's actually looking at 150 basis points of cuts, which at this point is kind of a little loony to think 150 basis points are coming this year, unless obviously we have some form of a black swan. All right.
Say, okay, now's the time to raise prices. Or if workers say now's the time to demand a wage increase. The thing is, we wouldn't have come down from 9% to 3% or 3.4%, 3.5% of CPI. That wouldn't have occurred if businesses were actually able to do this and workers were actually able to do that. What we're seeing, if you look at the inflation, when we get the data, and we look at it carefully here, we're still going to be in a situation where 80% of that inflation that we're looking at right now is simply the government's measure of shelter costs and auto insurance. You look at energy, food, goods, everything else, it's not particularly inflationary.
Somebody here is saying, I'm waiting for the Fed to say the January effect has spread into March, and this is just part of the bump.
I'm afraid I've got to wrap it up. Forgive me. Steve Rasciuto of Mizuho, alongside JP Morgan's David Kelly. To the both of you, thank you. If you are just joining us, the number 0.
Okay, a full price of rate cuts has actually now moved further back than even I've expected. First rate cut now expected after the election. Whoa, what a game changer, folks. First rate cut now expected after the election for 100% pricing on rate cuts. That's pretty remarkable. So what does that mean? Market, let's write this down. Market reaction. So it looks like now we're looking at first rate cut now fully priced for November after the election. Markets pricing just 1.9 cuts this year versus 2.6 yesterday, and yeah, that's an oopsies. So yeah, super core obviously we saw coming in pretty dang hot. That super core trend not great. Okay, let's see if CNB Sizzle's got any juice for us, but really watching the market open here is going to be the big play, because we'll get these fluctuations in pre-market, but market open is going to be the big one.
Shots and supply chain problems. But
so Rick, though,
bottom line is still the Fed's got a lot of work to do.
Take us inside the Federal Reserve right now. I mean, I imagine they're having a party inside Mar-a-Lago right now. I want to know what's happening inside the Federal Reserve right now, beside a pity party, which is to say, what do they do when they see numbers like this?
Well, I think the answer is that they stay the course, that they basically have a moderately tight policy, which was very effective in helping bring inflation down, and also, very importantly, very effective in containing inflation expectations from rising, which is one of the reasons why outcomes have been so good. But the inflation numbers are stalling now, and the economy is strong. So the Fed just has to keep staying the course. I don't think they need to raise rates, because I think that they're sufficiently tight in terms of the current policy stance, but they have to stay the course and indicate to the markets that that's their job.
What does that mean? We've been on this idea that there's a three rates cuts going. We had somebody on, by the way, who said there was going to be a rate cut starting in June and it was going to happen every month for the rest of the year, which I now is completely disbelievable. If it wasn't disbelievable, what it was said.
A little bit nutty in the sense that that would mean that we basically have a depression or another financial crisis, but I don't think that's in the cards. But we still do have a very strong economy.
And so, therefore, you think now, in this calendar year, as we get into a presidential election come November, that the Fed is going to do what? We're also watching the markets, by the way, we should mention, fall off. What do we got? The Dow off over 400 points right now. You got Bitcoin, by the way, that's fallen to the extent that's a sort of a indicator of speculations coming down to about $67,917.
So, the bottom line here is that the economy's hit a point where, in fact, it's good news in some sense, but the Fed has to do its job. And in fact, the Fed has always said they would risk a recession in order to get inflation under control. And I think that's the right thing for them to do. They have to be tough. Unfortunately, the progress that was being made has seemed to stall. And sometimes you got to say tough noogies. That's just the way life sometimes is. I don't think this is unusual for the Fed to have to deal with these kind of issues. When I was there are always tough decisions to make. But I think the bottom line now is they're going to stay the course, and they're going to signal they're going to stay the course unless things start to get a lot better.
Yeah, something that's interesting here is the 2-year yield right now. The 2-year Treasury sits at 4.9%. Now, what's interesting about that is what people like to do is they like to take the difference between the 2-year and the FOMC rate. And so the 2 years at 4.9%. Compare that to the FOMC effective rate at 5.375%. What that does is it prices in the easing that the market is sort of expecting over the next couple years in the Treasuries market. And you can see that's very, very nominal, 40 basis points of easing. Obviously, that still translates to the market thinking we're going to get rate cuts of about 1.9x. But moving this now to post-election is going to look very, political. But that is a game changer for Trump. Trump, if he's awake right now, I know you hear he stays up late sometimes. So I don't know if he's actually cheering right now. But if he wakes up to this news, he should be pretty happy. So that rate cut right now for the rest of the year, we've now moved down to still about 1.93, and then by January we sort of expect to get honestly. January is only pricing in 2.6 cuts. So let's write that down. January pricing in 2.26 cuts. So total by then. So really you're still, averaging 2 cuts between now and December and January. And so markets are really going to have to come to grips with this reality that, what is the Fed going to do to get inflation down? One of the issues you have is this higher level of supercore, this uptrend we're getting on supercore. I'll throw that up on screen again. This higher supercore trend is not going, it's going up with these high rates. And so it's not going to be long until we start peaking supercore out above where we were before we really even had liftoff. I mean, look at where we had liftoff. We had liftoff right about here at this peak. And we're trying to sneak back to that peak, yet rates are 500 basis points higher. So not ideal at all. Let's listen in here. And I also want to watch how the AI trade is moving this morning. I'll quickly do a search here just on NVIDIA is down 1.65. ARM is down about 2.5 on this hotter inflation data. AMD also down about 2.5. Let's listen in here.
I think the employment number on Friday gave you a good read of what was going to happen, of things that were going to have to cost more. We have tremendous.
Oh, Steve, I think I started getting, really respecting your crew a little more. Be blunt here. Like 4 weeks ago, I'm like, oh dear. That's 2 months in a row of bad data. What if we get 3 of bad data in a row? And here we are. Now we have 3 in a row. So, unfortunately, I also have to say I've really been liking this Windows computer. It's been growing on me. I'm still a little bit of a novice, but yeah. Damn it, Steve. It's commodity, Steve. So let's see here. What else are some of you folks are saying? Alex here says the demand problem at Tesla is worse than I think. I was at my local charging station when 2 Tesla employees showed up showcasing and offering demo drives for the new Model 3. That's interesting. So wait, why are they going to the superchargers? Oh, because they're trying to sell to existing customers? That's interesting. Now we can move, what is this? We can move into a clear recession. Yeah, I mean, there's also a risk of that. They keep rates high for too long. That's true. Kevin hates Trump so much he said he's probably sleeping. No, I'm basing this off of what Donald Trump himself has said. He's always said he's a late riser. That previously in interviews, and he doesn't popularize that much, but he's previously mentioned that he'll wake up around 10 or 11 sometimes because he'll work until like 2 a.m. That's just the way his clock is. And frankly, if you think about it, I mean, 10 a.m. is like 7 a.m. Pacific time. And I know that doesn't necessarily always align, but when we look at the market, I feel like it does. Market trading hours. Here, you want a pre-market trade, you got to be up at 5:30 in the morning. East Coast, you want a pre-market trade for an hour, you're going to be up at 8:30. It's not fair.
I have a lot of short rate paper, and I'm looking at it and I'm saying, wow. I mean, what do I do? Buy more short rate paper or buy CDs? The CD rates went down yesterday. It's kind of disconcerting. But I just think that there are a lot of people who are on the wrong side of this trade, and they're frantically getting out. And it's you see them first in the futures, and then there'll be a lot of people who are very scared, and they're in Mag 7, and they don't know what the Mag 7 are, other than the fact that it's...
Okay, I don't know what Kramer here is prognosticating, but you can see Sunrun, a very, and we literally specifically called out Sunrun yesterday as being one of the more volatile stocks when it comes to inflation, down now 8.2%. So you could have picked up you know, in hindsight here, obviously, a short. And even if you picked it up in the first minute or two, it has still been up on that short there on Sunrun. Look at that bounce there at the 174 on Tesla, trying to recover a little bit on the day. Got a gnarly bounce there. Now we're gonna watch the opening bell together, obviously, but we're also gonna do a summary here in a moment. I just want to get a few more comments here. I'm specifically looking for comments from Nick T. Let's see here. Okay. So Nick T did give us the trend chart. He indicated that, yeah, that's all he's actually given us. I'm actually surprised we're not getting a little bit more data from Nick T here, or charting at least. Usually he does a great job throwing together some more charts, but you do see that the trend of core prices on a 3, 6, and 12-month basis now all moving up. So we'll go ahead and put that over on ehack.com. Again, full summary over at ehack.com, and check out the Stocks and Psych group. We'll be raising the price in about 10 days as we come out with more lectures. If you've been adding lecture suggestions, by the way, I've been reading those. Thank you for those. Okay, so we have... That's Nick T. We've looked at his. Looking at some comments here. This is Reagan Capital says, U.S. inflation is re-accelerating and interest rate cuts are off the table for the foreseeable future. Unpricing those rate cuts is going to be really interesting. Let's see. BLS blew it for Biden, says somebody here. June rate cut odds plummeted. Yep, we saw that. Morgan Stanley says, now we are raising concerns that the prediction of the June rate cut might not happen. No shit. 10-year auction, sloppy. To underestimate one or two inflation reports may be a misfortune, but to miss several in a row looks like carelessness. March's CPI takes the tally to the 4 consecutive year-on-year headline outturns greater than the median estimate. It's getting harder for the Fed to justify rate cuts at this point. Yeah, no kidding. Okay. Let's see. Morgan Stanley core CPI. We really need to get to 0.2 on a monthly basis to see rate cuts. Somebody else writes here, I wish the Federal Reserve would pay more attention to what they do to financial markets with their manipulation of interest rates. Right. That's basically a way of saying, like, hey, why are they suggesting they're still going to cut as the data's coming in hot? This has clear political and economic implications. Absolutely. Higher government spending is probably contributing to this. Let's see here. Monetary policy is not as restrictive as expected. I'm going to write this down. So we're going to write implications via Bloomberg. This suggests, so we're going to say policy clearly isn't as restrictive as the Fed would like or thought. There are a lot of reasons this could be. The Great Resignation during the pandemic may well have heightened productivity in the U.S. economy. Higher government spending would also push up the neutral rate of interest, but every time we get a hot indicator, the case builds that it has happened and the conventional measures of the neutral rates are too low. Okay, so raises, estimates, again, of neutral rate. Obviously, huge political win for Trump with first full cut priced after the election now. And then we've got, okay, we talked about the 2-year. The morbid fear of central banks is to call an end to inflation only to see it revive. Yes, that's a good line. Morbid fear of the of central banks is to call an end to inflation only to see it revive. That's a fascinating line. That is so true. The morbid fear. Yeah. That's how you don't get your statue anywhere, when you screw it up like that. Let's see here. Obviously, very bad news for Joe Biden, I see written here. Yeah, and they're usually very apolitical here, but I don't think there's a way you can say that this is good news for Biden. It is bad. Okay. Oh, Nick T tweeted again. Oh, he had finished writing his article. All right, let's see what he had to say in his article. And let's see here. Nick T. And I'll go ahead and link his article. Okay. All right, Nick T. I'll go ahead and you can kind of see me in my little editor here. And the Wall Street Journal piece from Nick T. He just posted this. So stubborn inflation pressures persisted in March, seriously weakening the case for the Fed to begin cutting rates in June. Oh, okay, there we go. We're good. Okay. Consumer prices. Okay, we saw this move up 3.5 from a year earlier, touch higher than economists had forecast, and a pickup from that 3.2 in Feb. Yeah. Okay. Core rose 3.8. Of particular interest was the core moving 0.4. We were looking for 0.3. Remember that core, we're going to write this right here. Actual result, this is rounded from 0.36% for anybody who cares. And there we go. Let's throw in little percents there. So, again, that was 0.36. What else does it say here? Stock futures fell. Wednesday's report had been hotly anticipated because we had been basically pricing in more cuts. We've been optimistic about a soft landing. This is... here's that core CPI kind of... It's still trending down if you just look at it from a year-over-year number. But it's slowing its downtrend, right? And remember, we're always going to watch that multivariate core inflation read. That multivariate core, you could just Google multivariate core. But again, look at those probability bands. And if we just do probability bands here, you could see it's clearly a slowing, if not an outright uptrend there on what we're getting on inflation. So investors started the year expecting more cuts. Yes. Give us some news here, Nick T. Many economists remain optimistic. Despite this, rather than stoking inflation, this influx of workers might have reduced competition for labor and made it easier for businesses to meet demands, thereby curtailing price increases. This is, more of a historical idea. Got it. Average hourly earnings, weekly earnings, overall CPI. Okay, so a little slowing here. The Fed really wants this purple line, by the way, to be in the middle right there at about 3%. That's what you're looking for. Let's see. Making the case. Last week, Fed Chair Jay Powell and recent inflation data didn't materially change his view. That is true. So Nick T mentions last week, Jay Powell, recent inflation data hasn't materially changed his view. Okay, now the question is, where do we sit now, right? That's now I'm guessing he's going to have to flip on this. He's going to have to flip on this. How hawkish will be the markets next, I guess. That's the thing. It's like, how angry does he become? We might get a hint of that in some of the Fed speak, but if you get a hawkish Powell that says, look, we're at 3 months in a row now. If this continues, we have to go for rate hikes. That's going to be a problem. He also said officials would need more confidence. This doesn't help. Gauge incorporates not only CPI, but producer price. That's fine. This PCE, fine. Fine. By all measures, inflation has eased substantially from its mid-2022 peak. That's fine. The vibe gauge. Americans remain frustrated. Weighing on sentiment. Mortgage rates, for example, closely linked to treasuries, have climbed. Blah-de-blah-de-blah-de. All right. That's a little bit of our update from Nick T. Let's listen in here, and then we're going to do a quick little summary, and then we're going to get the opening bell.
Because we have to endure Jamie Dimon saying he's very concerned that that's tomorrow's business. I mean, Friday's business. James,
we're getting J.P. Morgan right.
Yeah, well,
starting with memo. Starting earnings season begins end of the week. We get the banks.
Come on the call,
but obviously we're working off of Jamie's comments from his annual letter, in which he said that rates could hit.
Yeah, blah blah blah. Now keep in mind, one of the things that I've been doing over the last month in the face of some of this higher data is I've just been trimming. I've been increasing my cash position, so especially AI. I've done a lot of AI trimming, my exposure to AI. And so, so far that's been good. I'm not opposed to AI. Don't get me wrong. I don't want people to think I'm anti-AI. I just think it's gone a little too far. And, I like that NVIDIA is now in a correction. It's down 10% from its peak. AMD has been in one for a while. You're down like 19 to 22% now. And I think there's some potential opportunities that'll present as a result of some of this. Let's go ahead and do a quick summary on this, just so we can get that out of the way. And then we will get into the opening bell. So if you're just now joining, I think that'll also be useful for you to get a little bit of a summary. And we'll make it quick. We'll try to do maybe an 8-minute summary here and see what we knock out. Okay, here we go. And I just need to push this button here. Okay. Well, Donald Trump should be very, very happy because rate cuts are now fully priced in instead of for this summer or as early as September, in November. But those rate cuts, that rate cut meeting comes just a day after the election. So that means there is a chance we will get 0 rate cuts until the election is over. A big win for Donald Trump, especially since, even as Nick T mentions in his Wall Street Journal piece this morning on CPI, Americans have had it with inflation. And unfortunately, the CPI report today, which was supposed to give us direction, was January, February just a bump on the road, or was it a trend of inflation resurging? Well, the numbers came in hot. As outlined over on ehack.com to make it easy for you. Remember, every time you go to Pooper, check on ehack.com. What do you got? CPI month over month, you've got a 0.4. Every item comes in 0.1 hot. You can see that on screen here. Core, month over month, year over year core. Everything comes in 0.1% over expectations. Markets looking at just 1.9 rate cuts this year, maybe 2.26 by January. The super core trend is not great. The super core trend is the biggest problem that we have right now. The last time we had a rise in super core was really when the Federal Reserve started freaking out. You'll see right here in about September, July, August, September, we bottomed out in super core in 2021. Unfortunately, we skyrocketed until the Fed lifted off on interest rate increases, in March of 2022. And we are now trending towards the longest uptrend in the super core. Now, super core is exactly what we pay attention to. Every single time we get a CPI report, the first thing we do is we jump in over here and we go, what's going on with services? Pet services up 1.9. We warned that we wanted to pay attention to insurances, pets, financial services, healthcare, all of them hot. Motor vehicle repair 3.1. This is month over month. So when you annualize a 3.1, you're talking 36% inflation. You just multiply it by 12. Don't use exponents when you annualize. 3.1% on motor vehicle repair, insurance 2.6, motor vehicle maintenance and repair 1.7. You've got health insurance up 1.2, hospital and related up 1.2, medical care services up 0.6, household operations up 0.8, pet services up 1.9, postage delivery 0.4, other personal services 0.8. Not great. All of these hot. That's super core rising. Since we did touch on medical, I want to give you a quick little heads up, by the way. Summer. Baby summer, I'm already starting to talk to a discharge nurse, so we could be within 2 weeks, knock on wood, or 3 surgeries are done, and she is recovering, so yes. But anyway, baby summer, hopefully we'll be home soon, so all 7 babies will be home. But anyway, going to the super core chart, this chart over here on the right is rough. This is a rough chart. The chart is going in the wrong direction, and so now you have to look at the implications. The implications are, A, clearly policy isn't restrictive enough. Clearly the Federal Reserve thinking that 5.5% rates is restrictive is not. It's not restrictive. How could it be deemed restrictive if Supercore is skyrocketing the way we see Supercore here? It's crazy. Then this also raises the estimates of the neutral rate, which reduces where we might end up going with interest rate cuts in the long term. The idea that we're going to go back to 0% rates is basically killed by reports like this, where inflation is continuing to resurge in the face of very high policy rates. And the economy is still chugging along. We don't have jobs weakness. If anything, we have jobs strength. Yes, some of that is affected by immigration, obviously, but the jobs market is broadly expanding. There is a renewed risk of a wage price spiral, especially since we think the ECI reports are going to come in hot, in part due to California still raising minimum wages during a time we're trying to get inflation to stabilize. Now, I'm not here to say people shouldn't earn more money. I do think people should earn more money. But I am also concerned that if from an economic data point of view, we start getting signs of a wage price spiral, the Federal Reserve will be forced to drive us into a recession. Again, this is actually what we're getting right now is good for Trump in the short term, because not getting cuts until November means the Federal Reserve is kind of going to look like they're behaving politically. The moment Trump potentially or the new president gets elected, that's when you're going to get rate cuts. Whoever obviously ends up winning, of course, delaying that until then is going to look very political. But, you know, the data is also driving them in that direction. The problem, though, is if you stay at those higher levels for too long, you do increase the chance of a recession. A recession could end up on the next president's plate. So whoever it is, whether it's Biden or Trump or whatever, it is very possible that with rates having to stay this high and Supercore moving up like this and a potential lead into a wage price spiral, the Federal Reserve is going to have no choice but to drive a recession to actually finish the job on inflation, and the Federal Reserve will do that if necessary. Obviously, this is not good for your interest rate sensitive stocks. Yesterday, we anticipated that the most volatile mover would be Sunrun, followed, of course, by the other interest rate sensitives. We thought there was maybe some hope for artificial intelligence, but at least this morning, there's really hope for basically nothing. The only thing there's hope for is the volatility index, Alibaba, and United Airlines. Other than that, you've got Sunrun down 7%, Open Doors down about 7%, Wayfair's down 5%, Enphase down 5%. You've got the TQQ down 3.9. That's because obviously your index is down about 1.3% right now. RK down 3%, Cheesecake Factory down 3%. You've got Tesla over here is actually only down about 1.8 ish. Nvidia is down about 2%. Nvidia now in correction territory along with AMD, and you really want to watch on Nvidia that 850 line. We are below that 850 line right now, and that's a big deal for Nvidia. Getting below 850, it is a support level. Breaking could bring us back to 731 for some violence. ARM, for example, down 2.5% on the day, though that's also been sort of a volatile up and downer. We'll see what happens, though, but with markets. But right now, you've got the bond market looking at a 4.48% 10-year yield. You also have inflation break-evens moving up. The 5-year inflation break-even is sitting at 2.55%. And the trend of the inflation break-even chart is not good. Keep in mind that Jerome Powell consistently says that inflation expectations remain well anchored. This is in the face of inflation expectations, just one measure of inflation expectations, moving up rapidly. You can see on screen here, we've been straight up since December. Jerome Powell has not changed his tune at all, and the question now is, what is he going to do, and what is the market going to react with when Jay Powell really ends up, going, oh no, oopsie doopsie whoopsies, we screwed up. When we get that commentary from Powell, how markets will reply will be very obvious, will be very interesting. Obviously, we're expecting to get Fed speak this week. We will get minutes today at 11 a.m., though I'm not sure how useful the minutes will be, given that we just got a third month of hot data out. So if you get minutes that say, hey, 2 months could just be a little bit of a bump on the road, unless we get some kind of hedging bets like, hey, if we get 3 in a row, that would be bad, then these minutes might not be very useful today. We're really going to be looking for is that Fed speak coming. Bowman today. We'll have other speakers going forward the rest of the week, like Walker will be speaking towards the end of the week. So we'll cover the Fed speak. Clearly, Raphael Bostic was not informed of having any kind of sort of pre-leak on what's going on, given that Raphael Bostic suggested, hey, it'd be great if we hit consensus. And you know what? Maybe, he sort of acted bullish, rather, and dovish, suggesting, hey, consensus or a little below would be wonderful news. And just accepting consensus at even where it is, somewhat implied, hey, maybe he knew what the data was going to be. Turns out, no. Maybe only J-Powell gets the data ahead when he wants it, but doesn't look like Bostic had any kind of clue. And so the market and its run into the close yesterday wasn't really led by anything other than speculation. So, again, coming in hotter than expected here, also hits our trend numbers. We'll pull up the trend numbers here, which thank you, Nick T, for throwing those up. But Nick T gave us the trends, and this is the problem. The trend is not our friend when it comes to inflation. Here you go, on screen now, you've got Nick T. Everybody loves our Fed Whisperer. He gives us the 3, 6-month, and 12-month basis. And those here say what's going up are the courses on building your wealth from Meet Kevin, including all of the buy-sell alerts, trade alerts that we send in the Stocks and Psychology of Money group. We'll have a price increase within about the next 10 days on those. If you want to bundle up, make sure to email us at staff@meetkevin.com. You could bundle up with the event or other courses if you want, if you're an existing member or a new member or a curious member and you have questions. But anyway, so staff@meetkevin.com. But anyway, look at that core consumer price index right here. You see that 3, 6, and 12-month trend solidly moving up here. This is an issue because, again, at 5.5% rates, it means the Federal Reserve is not managing to control this inflation problem. So a little oopsie-doopsie. Again, we're not pricing in our full rate cut until November, and we are moving down on rate cut expectations to just one. Okay, we've just moved down even more. That's incredible. We are now down at 1.69. I'm gonna throw this screen on this chart on screen rather, but I want you to first see yesterday's data. So I got yesterday's data. I'll show that on screen first. Yesterday's data is right here. This is what it looks like in terms of the market pricing and cuts. The way to read this is these bars are basically number of rate cuts priced in. And if you hold your mouse right here for December, you'll be able to see we're pricing in negative 2.6 rate cuts as of yesterday. Negative 2.6, so basically 2.6 cuts for yesterday, okay? Today, we have now moved that number down again, because we were at 1.9. If I now hover over December, I get 1.692. That's it, 1.692 on rate cuts. That means we're getting to only pricing in about 1.5 rate cuts at this point. That might end up moving down on hawkish talk here to only pricing in 1 rate cut for the year. So big implications here, obviously, for the market broadly, for treasuries. We'll see how the market responds as the day's trading moves. I really think it's going to take probably the whole trading day to kind of figure this out. And then obviously we'll get PPI tomorrow as the next catalyst, and then we'll get Fed speak coming up. PPI for tomorrow, month over month, is expected to be 0.3. Core month over month is expected to be 0.2. Core less trade is expected to be 0.2. So we'll see. Usually those producer price numbers do come in lower. And then at the end of the week, we'll get sentiment, University of Michigan inflation expectations. Those are usually something that is closely watched or are closely watched by J-Powell. So we'll look at those. Next week, we'll get retail sales, building permits, and some other smaller data sets as well. But obviously, 3 months now, much more than a bump in the road. This is turning into a trend. It's not great. Let's see how markets respond, though. Can we get a market rally here in spite of maybe not having rate cuts? Let's find out as we get ready for the trading day. Okay, So L video is done. That took that was a 13-minute summary. Okay, whatever. So let's go ahead and get ready for the bell here. It does look like you've got Tesla rotating slightly down into that open there, but it does look like the Qs and AI are trying to reduce some of their fall. You've got the Qs down at about 1.2%. They were down as much as 1.5%. ARM's only down 1.6%. That was down as much as 3%. So it does look like you've got a little bit better news there coming into the actual pre-market. But again, we've got 20 seconds to go until the bell actually happens. And so then we'll get a dose of reality and we'll see which way the market actually wants to go. So buckle up, get ready. Get your coupon code, get your life insurance paid promotion within as little as 5 minutes by going to metkevin.com/life, and let's get the bell.
Come into the house because I don't want pebbles all over my house.
Yes, pebbles now.
Bam, bam.
I'm off on ARM. All right, here's the opening bell. Take a look at real-time exchange. Not unexpectedly, a lot of red on that board. Here at the big board, Aruna, that's a healthcare provider in Latin America. It's celebrating its recent listing at the NASDAQ. Recent listing. Over at the NASDAQ, we got the National Security Emerging Markets Index ETF. Because, Jim, there is an ETF.
That is really red. Very red, but it does look like the market's trying to get us a green candlestick here. We can see ARM's down about 2%, but it's trying to green candle on the average. We've got the Qs sitting at 1-2, trying to find direction here. Market doesn't know which way to go yet. Tesla's trying to green candlestick, gets rejected at the 174 again. Sunrun going down at 755, trying to figure out direction. Can't figure it out. Which way are we going to go? We're not sure yet. We've got Enphase down 4.4. Also, nobody knows which way to freaking trade this. That's what's happening right now, is everybody's kind of like, okay, are we going up? Amazon's going up, but then again, Amazon being down 1.3% seems a little weird on inflation, but okay. Apple up 0.48%. You've got, what else we have here? Dell's down 170. I mean, none of these moves are really that drastic. Frankly, here, 167 on NVIDIA, not a big deal. You've got Tesla, 1.6, not a big deal for 3 months in a row of hot inflation data. I'm not sure if we're going to end up holding these levels today, but we'll see. Again, trying to figure out direction on the Qs. Still don't have it. Sunrun trying to recover here, actually. Meta's down 166. Enphase recovering. Look at that. Fat green candlestick. Here we go. Here comes the direction. We're going up. Enphase only down 3%. NVIDIA's going up, only down 132. 1.4. Look at Tesla's. Tesla's trying to break through. Q's trying to break through. Looks like that direction is trying to go green. Let's listen in here to see. Ooh, Alibaba. Hold on a second. Let's
Go to China.
Yes.
And basically slam the Chinese.
A lot of people, by the way, making big bets on Alibaba, thinking Alibaba might be bottoming out here. Let's listen in.
Try to sell more Prel, for heaven's sake. Remember that? We're supposed to open more plants there and take share. Meantime, what happens? Tim Cook! Devices in India.
Yes.
Okay. All right. Yapping by Kramer here. Look at that. Q's going up. Q's don't care. Q's do not care right now. You are now down 1.08 on the Q's. That's actually much better than where we started. Sunrun is still down about 6.6. I'm not sure how much of this is by the dip of the AM. Let's unaverage for a moment here. Yeah, let's see here. I mean, Tesla's, it's really trying to break above that 174 level. ARM's barcoding a little bit. We're about to be less than 1% down on the Qs. Honestly, for a bad report like this, it's actually pretty good. This is a pretty good movement here. Etsy down 1.3, not bad. Again, Tesla here, and trying to go back to 1.8. Again, first 20, 15 to 30 minutes of the trading day, really tough to really get that directionality. So watching this closely, we're now on the unaveraged candlesticks. Qs, we're about to go less than 1% down, but looks like we might be stabilizing here for right now. Same thing on Tesla, sort of stabilizing with where you open. NVIDIA stabilizing where you opened. Enphase stabilizing where you opened. Amazon is trying to pump it up. And so straight up here on Amazon, Apple doesn't agree. Google doesn't agree. You've got Intel moving down again, 77 bips. Peloton's down 7%. How's DJT? Honestly, DJT should be up if it follows Trump, things that are good for Trump. Nope, it's not. It's down about 3% right now. And again, somewhat stable here. We're now back to where we opened on the Qs, which was about 1.2%. Tesla's sitting at about that 1.7, 1.8 level. Really watching NVIDIA as well, especially now that we're in that correction territory on NVIDIA. How much buy the dipping are we really going to get here? Are we going to wait for Fed speak? Are we going to wait for more clarity on which direction to go? This is, obviously the first 15 minutes of volatile trading. So I want to see if maybe Doomberg has anything juicy for us to talk about with market reaction. I'll also look at some more comments from the suits in just a moment here.
Third place behind Amazon AWS and Microsoft's Azure. The real thing that the street is seizing on is their Google Cloud Platform's developers application, which is called Vertex AI. And in a demo that Google gave Bloomberg, they basically demonstrated how if you're a marketing firm, you can upload images, marketing-related images, to Google Drive. The generative AI or Gemini 1.5 Pro model then takes
NVIDIA's running.
Basically ask it to do whatever you want. Make me a slideshow or a presentation based on those images. They also showed off cybersecurity use cases and other app development. And it's the first tangible sign that Google feels that the model that they have out in the marketplace, Gemini Pro 1.5, is ready for real time. It's ready to be used in the enterprise use case. And across all of the sell-side notes, there are many. If there's one commonality, it's that this will see Google accelerate its cloud growth and potentially continue to chip away at market share at the number 1 and 2 placed AWS and Microsoft Azure. But yeah,
a lot of competition over there in that AI data center space. Look at this candle on NVIDIA. NVIDIA is really climbing for that 850 level. Remember what I mentioned pre-market. 850 is a must hold for NVIDIA. Otherwise, it gets bad. So good on NVIDIA here for trying to get back to that 850 level, because the next stop is 731. Otherwise, for NVIDIA, be a little bit of a correction there for the AI plays. You're already down 10% on NVIDIA, maybe about 22% or so on AMD. AMD's down about 1.3. ARM's down only about 0.5% on ARM this morning. So you're almost getting more volatility on NVIDIA than you are getting on ARM, which is a little bit surprising. Market now moving up. The Qs are now down less than 1% on this move. This is a sign the market is starting to care less about the impact maybe of rates or inflation. And the market has just decided, you know what, we don't really care. So you are getting a broad movement here. It looks like NVIDIA is actually about to turn green. Usually we don't end up with less than a page of green. Just like we usually don't end up with less than a page of red. We generally get a relatively balanced market on the day. And we are watching, obviously, as we get some greens here. Let me see how many green shoots we have right now. If I go to just greens, yeah, we're still only sitting, I mean, 2 of these are volatility. We're trying to get there, but we're still only about 4 or 5 of these actual tickers right now that are green. And Qs kind of struggling to really keep it up there. And NVIDIA wants that 850 number pretty badly. But the SPY's going nowhere right now. Let's go to the average candles again. Qs really trying to keep it up. It's having a hard time. Tesla's having a hard time keeping it over 174. You could tell this is a market that wants to buy the dip. I mean, just based on the first 8 minutes of trading, it could be nothing, but I like to read into it. And to me, this is a market that wants to buy the dip. It wants to be bullish. It wants to be invested. But it's being told, get your buy-sell trade alerts from me, Kevin, in the Stocks and Site group, link down below. But other than that, it's being told, look, you need to be a little more bearish. So that's, I think, we'll see how the day ends. NVIDIA, though, this is being seen as a buy the dip opportunity, the move under the 850 level. We haven't been under 850 before, so short little window there to dip on NVIDIA under 850. Closing above 850 will be a big deal for NVIDIA, as we've mentioned a few times now. Let's see here. Okay, let's listen in here for another moment.
Overall CPI. Uncomfort, or discomfort, one could say, in Capitol Hill as well?
Yeah, and the problem is that the Federal Reserve really can't do anything to control either one of those. That's going to have to come from some sort of fiscal policy or government change there. But the Federal Reserve can't control gasoline prices, and they can't build houses, so they can't make home prices go.
Yeah, no. This has nothing to do with gasoline prices and housing. I mean, of course, those are contributors, but let's be real. That super core inflation chart is skyrocketing. I mean, you're trending straight up, and super core literally removes housing and gas prices and energy prices and food and goods. So when you hear super core, I really want you to think of personal services, massages, financial services, insurances, health, motor vehicle, whatever, repairs. Those are all a very big deal. And so, clearly that lady isn't paying attention to what she should be paying attention to. Anyway, look at this NVIDIA riot here. NVIDIA is the only thing running right now. Is trying to drive those Qs up. DJT is actually moving up. It's only down about 1.6 right now. Tesla down about 2. ARM's recovering. Enphase down 6% on Enphase. Sunrun's almost down 10% on this news. Amazon 70 basis points. Apple's down almost a full percent here. Holy smokes. Salesforce down 0.66. ASML is down 1, Peloton's down 8, Palantir's down 1. Wow, Restoration Hardware gets slapped in the face, down 6%. That totally deleted their last earnings optimism. I mean, they had a nice rally there after earnings, but boy, they really gave it up after that. So Robin the Hood is down about 2%. How's BTC moving? We did see about 1,000-point drop in BTC after the inflation numbers. We are holding on to that. We've really been, well, I like to say magnetoing or like playing the magnet or the rubber banding around 69,000. And we gave that up. We did not get an early market pump, which we sometimes do. Instead, it looks like we got a little bit of a bumpy doodla there, now down to 67.6 on BT Sizzle. NVIDIA doesn't look like it's able to keep it up. You're getting your first sort of red candle here on the average. You can see the non-average might be topping out a little bit. Will that dip buying continue? We'll see.
What was it down on the great day of the crash?
Give me the cash.
508.
Let them figure it out as a private company.
Okay, fair enough.
All right, great. Glad we had settled that. We don't need to discuss.
How about poultry?
We don't need to
David?
discuss Macy's.
Poultry
again.
was up.
Enough with
Eggs
the
was
CPI.
up. Well, why do you think the market's down? Because of Macy's?
I don't know. You want to talk? Let's talk about UBS for a minute. Let's go overseas, shall we? Bloomberg story.
What's that have to do with
UBS. Okay, Biden is now calling on companies to use record profits to cut prices. Yes, because that's how that works. All you need is the president to say, please cut your prices, and that will solve it, because that's how the free market works. Most of the strength in core is explained by former motor vehicle insurance, says JPM. No, it's way more than that, man. Way more than that. Yeah, transportation was a big sector of it. Let's see what some other suit reactions here. What others we have. Treasuries. Ooh, let's also see now that the market's open how treasuries are moving. You've got 4.47 on the 10-year. It's pretty high. It's the highest really since the October-November Bill Ackman drama. Let's see. Options for futures are pricing in a higher probability the Fed is on hold or hiking this year. Wow. Okay. We're looking at just a single cut potentially being priced in at this point. Reacceleration of supercore indicates strong readings weren't a blip. Sticky inflation. Easy financial conditions continue to provide a significant tailwind for growth and inflation. Yeah, no kidding. Financial conditions have not been this loose since like 2018. So, you know, if the Fed wanted tight financial conditions, you're losing them. You know, the Goldman Sachs Financial Conditions Index has been straight down essentially with some of this latest data. So market reaction, which is ironic, you know, you'd think it'd be the other way around. I think mostly because people have been so hopeful and they've been looking through some of this latest data. And NVIDIA, again, just doesn't care right now. Maybe trying to move into earnings here. Or, you know, what could be happening is maybe people are moving from interest rate sensitives into NVIDIA. You do see that, you know. You see this idea that, you know, do you sell interest rate sensitives? This is going to take longer. Do you go into a stock like NVIDIA because it's on sale 10%? Everybody's talking about how NVIDIA has gone back into correction. AMD's been in it for a while and is now that buy the dip time. I don't know. We'll see. So, yeah, again, clear economic, political implications here with a first rate cut being priced in for after the election. All right, now we're looking at, again, PPI tomorrow, so buckle up for PPI tomorrow. Maybe that could sort of soften the blow of some of the damage today. Wow, NVIDIA is now up 1%. Really did not want to stay at this level. Yesterday, NVIDIA did fall below that 850 level, and we're going right back up above that today. And this is actually driving the Qs back up. As you can see, the Qs are only down 89 basis points right now, almost straight up there since the market open. Looking at, let's see here, what else? American Express down 1.2, Hood down 1.2, SoFi down 2.0, Matterport down 3.73, RK is down, what is this? ASML down 1, Intel down 60 basis points, Apple's down 90 basis points. And watching this NVIDIA run very, very closely, now at 860. So good for NVIDIA. It looks like Tesla just took another leg lower, now down about 2.6. Probably weighing a little bit more here on the IS stocks. Yeah, looks like you're going right to about 113 there on Enphase. Really, you've been between 113 and 119 for the better part of about 3 weeks now. You were up to about 130 there about 4 weeks ago. You know, bobbing around those 130s. So, all right.
It's not going to come public here. But, I mean, put a multiple on 40 billion EBITDA growing at that rate.
I'm astonished that it's that big. That was something that might transcend even the problems we have. Fitch downgrade.
It is one of, if not the largest private companies in the world. Yeah.
That's incredible. Yeah. Incredible.
I'm glad you appreciate that. All right, now you get to talk about a public company again, Jim. Go ahead.
Okay, I'm going to do that. I'm going to talk about...
you got to go through notes? Isn't it in your head?
David, I'm going to talk about Tesla.
Oh, okay.
Every day, the long knives are out for Musk. You know, just when everything was going up, everyone was a fellow traveler. They loved him. Now that it's going down, he's tripolar. And which is really unbelievable. I think they're studying that at Hopkins. And I just find, David, he's despised. I mean, it's incredible. Full self-driving, you know, here we got to
nobody believes in full self-driving.
Lithium is bottoming. Remember when he devoted one call to the incredible rise in lithium? Well,
lithium mining, they were,
he got that going, but I think when he lacks his sales, that's often imperative.
I feel like you've been warming up to the stock, though, a little bit. Am I wrong?
No, I'm just saying, look, what'll happen is Kathy Wood will come on air. She'll use a 200 times earnings, $800 price target. People say it's the bottom because it's Kathy Wood, and then you'll get around.
Or Ron Barron will come on and say it's going to be a $4 trillion market cap.
These are fellow traveler, amen corner people. They always come on our air. They always say it's done going down. And no one said, if I said NVIDIA's done going down, and it doesn't, I mean, they're going to put me in the stockade over here in 55 wall.
They got a nice safe downstairs. They could just put you down there, way down deep. Yeah.
You never hear from me again there.
No.
But anyway, I'm just saying that Tesla, right now it's on the other side, so everyone thinks that this unbelievable magician, brilliant man is no longer capable of coming up with anything. And I'd rather be an insurer. I'd rather be in Buffett with Geico.
I'm not sure you'd rather be in the banks this morning as we await earnings later in the week. As you might expect, Bank America, of course, that bond portfolio, always, you move up and right.
I like how he transitioned that to banks after Cramer's. I couldn't actually really figure out what direction Cramer was going there. It sounded a little negative on Tesla, but it wasn't very clear because it's sort of people have lost hope in Musk. He was just sort of making observations there. It sounded a little negative, but if it was clearly negative, you should sell Tesla, that would be bullish, right? Anyway, so wow. Okay, so BTC 67.5. Looking on the hour chart for the BT sizzles is not very useful. We are below that lower trend line. Again, we've been watching this and coming out on that week chart there. Nah, week chart's not too useful. Day chart, a very, very clear consolidation pattern here. It's just the question now is, can we actually break up going into halving? Yeah, it's coming up soon. What do we got, like 11, 12 days, 10 days, something like that? So we're getting really close to the halving here. And then the question is, where are we going? Are we going to 102? That's the next stop. Or are we going to 57.5? So that'll be a big deal. We'll be watching this very closely. Q's still down 1%. That's despite NVIDIA going green out of freaking nowhere by the dipples. Wow, Tesla's all of a sudden down 3%. Enphase down 7%. You don't want to see it break these lines. It's going to lead to some negativity here in the AM. Wow, Microsoft, Google, Amazon, all of them down just over 1% right here. One of the things to keep in mind that I'm doing is I've still been focusing on raising cash in terms of like trimming some of the hotter AI plays and just raising a cash portfolio. My I've been kind of thinking, somewhere around 30 to 50% cash going into this report is good. The question now is it by the dipples time? And I think a lot of that is going to be driven by slightly, to some extent, PPI tomorrow. But honestly, Fed speak, what are we going to get? Because if you get a Fed panic where the Fed says, hey, we're going to have to start thinking about putting hikes on the table, the market's going to have a hernia. And imagine, for first-time home buyers, too, who bought a home in 2012 thinking, oh, I'll be able to refinance in a year when rates go down. Yeah, right. You might have locked in a good rate a year ago. Now it just keeps going up. So it's been very difficult for first-timers to get into real estate. And, still seeing this dip continue here. Getting a little bit of that bleed out as Tesla now down 3.3%. AMD is still down over 1%. Kind of surprising on some of these Mag 7s here. AP funding, if you're having trouble, there's a Lecture 1. Lecture 1 teaches you how to get into Discord. Thanks so much for joining the group, by the way. And then if you ever have questions, you don't have to donate $2 here, as much as I appreciate that. You can always just email us at staff@meetkevin.com, and we'll get you taken care of right away. Folks love the team and the staff, so we'll get you we'll help you out. And make sure you'll get taken care of. So, but yeah, otherwise, me today, I'm gonna watch. This is gonna be watching how the market responds throughout the day today, especially when we start getting Bowman commentary. That's gonna be the tell. Because look, the Qs are topping, right? And this CPI report does not help. These are the Qs right here on the average candlesticks. And you can see we're having trouble breaking out to that next level. The same is true on the SPY. You're topping out. You're in this no man's land as well, but you've topped out at about 524. Now you're sitting at that 513 number. NVIDIA's trying to run, which is great. It does not like being at this level here, this 850. So it is trying to break free of that. But also, you've really come off your 970 peak there on NVIDIA. And so maybe markets will keep buying the dip today. One last look here at bonds, and maybe if Nick T has said anything else. Former Trump executive Alan Weisselberg sentenced to 5 months in jail for perjury. Okay. And then we've got 4.49. 4.49 on the 10-year right now. Looking to see if there's anything else from good old Nick T. Fourth consecutive month, CPI comes in warm. Yes. And then we've got, no, Nick T just retweeted his article. So that's it. Okay, well, in that case, let's go ahead and push the button. Remember, folks, join those courses on building your wealth, specifically the stocks and psych if you want buy-sell alerts, the Zero to Millionaire Real Estate course as well. And if you join and you don't see a lecture that you need, I've added lectures to these courses for years. I'll do it again. We've got the Entrepreneurship and AI course, which is the gold course. People love that one for making more money. So you want to learn how to make more money, how to be more productive in your life. Use that gold course. It's really great. It's not on investing in gold. It's like, we just call it the gold course. Make more money and get SH9T done faster, right? So check that one out. You've got Stocks and Psych, obviously, trade alerts, and also budgeting, personal finance, really great. You've got zero to mill real estate, do-it-yourself property management's another good one. A lot of people bundling between these, so just email us if you need a custom bundle at staffandmekevin.com. Adding new lectures within about the next 10 days to align with another price increase. So let's go ahead and hit the button.
Go yourself.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Well, there you have it, folks. Looks like you're trying to get a little bit of a U-turn there on markets. Let's see if we can keep moving it up. Thank you so much for being here, and folks, we'll see you in the next one. Goodbye and good luck. Get another cup of course and then we'll go to the Course Member Live. Bye.